because the hospital space is in focus as JPMorgan has issued a bullish note on the sector. The brokerage says the sector is ripe to absorb expansion. In our special Insight Edge, I'm here to present why exactly JPMorgan is bullish on the hospital space. So, for example, they have an overweight with a target price of 5950 on Apollo Hospitals. For Fortis, they are overweight with a target price of 355. Max target price of 620. They are neutral on that stock, along with even Medanta, the recent listing, which has where they have a target price of 710, and they're neutral on that. Now, JPMorgan says that there is secular growth, supply shortages, which offer promising growth prospects going forward. They believe there is sustained demand, occupancy at near optimal levels, which necessitates expansion for the hospital space. Both organic as well as inorganic is something that a lot of hospitals are looking at. Profitability improved according to them, and that is likely to sustain as well. So they forecast a 19% EBITDA CAGR over FY23 to FY26. In fact, we did speak to Narayana Health. A couple of important takeaways from the management is that the cash flows of hospitals have improved during COVID. And India is actually a very underserved market, and there is much more awareness which has taken place post-COVID as well. They are not averse to M&A, but they will be careful. They have said that the valuations have really heated up in the space. They have sufficient space when it comes to borrowings. They are cash rich, 650 crores of cash on books. They want to expand in core markets where the company has a significant brand dominance, for example, Kolkata as well as the Bengaluru market. And they've currently taken one of the lowest price increases possible in the market because they do understand that they can't pass on the entire inflationary burden onto patients, and hence they have taken only a marginal price increase. They may see slight dilution in margins, and they have no intention to sell. Stake promoters hold over 60-odd%. In fact, let's listen in to the group CFO who we had a chat with earlier in the morning.
The cash flow positions of many of the hospitals significantly improved. And we also believe that COVID kind of made people far more health conscious. India is one of the most undertreated countries in the world, where people don't come, they feel that going to go for treatment is like a bad thing. So people don't do proactive checkups. People only come for a health issue when it's really very serious. So it's a very underserved market. While we are not averse to M&A, but we will be very careful. We won't throw money at a very high priced asset because then we'll not do justice to the patients who walk in. We won't be able to continue to give them the kind of affordable care that we are giving them today. We also have sufficient headspace in our borrowing as well. So depending on how we want to deploy the cash, we will make a judicious choice between internal accruals and borrowing. Last year, it was about 40-60. We spent 40% of our capex from internal accruals, and maybe we will maintain that kind of trajectory into the current year also. As far as where we want to spend, we want to first expand in our core markets where we have a significant brand dominance.
All right, so that's about the